All right, so today we're going to be talking about working capital. Working capital, very quickly, is current assets minus current liabilities. A question we get a lot is, how do we calculate this? It's going to be a quick summary, but in essence, you take the prior trailing 12 months of financials, so your revenue, your expenses, profitability. You're going to be taking a look at that, and you're going to be determining, along with your other transaction advisors, so your CPA, your deal attorney, your investment banker, you're going to be determining how much cash does the business need to operate for the next 30, 60, or 90 days? So you're going to be looking at that trailing 12 months of financials. You're going to be tossing out any variables that are there, and then you're going to be setting a target working capital peg. Peg, target, those terms are used interchangeably. But that calculation, it's not often an exact science. So in a transaction, parties will work in a true-up period. So once the transaction is done and closed, within the next 30, 60, 90 days, the buyer and seller get together again and they go, hey, was that enough working capital? Do we have what we needed to run the business? If there was too much there, then the buyer is going to return some of that money to the seller. If there's not enough there, the seller is going to pay some to the buyer, or the buyer may pull it out of some escrow or holdbacks. But all of these processes and procedures of how are we going to calculate working capital? How is it defined? How are we going to go looking at it in the transaction? It is laid out and spelled out in the transaction. There are definitions, formulas, etc. There's even a methodology for if the parties do not agree and they end up getting into some type of dispute. There's often a dispute resolution mechanism worked in. So essentially, in a nutshell, that is how you calculate working capital.